Hi, this is Edward Lambert with the Effective Demand Research. Okay, this is a follow-up to the last video on raising taxes on capital, which will raise the equilibrium level of real GDP. So let's run through this again. Let's do a little review. We start out with 15.599 trillion coming into the economy. It goes through and comes out as 15.662. So it's rising. There's some injection going on here. So we do a goal seek to find out where its equilibrium level of real GDP is. Set that equal to 0. So as we see, it came out to 16.116 trillion at that level. Okay, now let's go back. And we are going to raise taxes on capital. Run through this again. Got to do the goal seek to change the taxes back to their level. Okay, so now we raise that up. If we raise the effective tax rate of capital, lower the effective tax rate on labor because there's a transfer going on there, an extra transfer. So now we find out where the economy goes as far as an equilibrium by changing this. So we change the initial cell and we'll go through a number of rounds, and now we see that it goes to 16.6 trillion as far as the real GDP equilibrium. However, if you raise taxes on capital, you have to figure that their marginal propensity to consume, let's say it goes down to 23% from 24%, just a 1% drop. And then you take marginal propensity to invest. Now it's not so likely you're going to invest because there's higher taxes, higher costs associated with the investment. So you knock off a little bit of the investment. Let's take the 16 down to 15. All right, so we've raised the taxes on capital, but we've also had to offset that with a change in their marginal propensity to consume and their marginal propensity to invest. So we made a 1% change in each of those. Now let's do the goal seek again and find out where we are. Take this back down to 0. Change the initial thing, go through the rounds, and we are now at 15,000. We're now below the original level. We started at 15.5. We've now gone below the level. So even if we made a marginal change to the marginal propensity to consume, and let's say just a marginal change to the marginal propensity to consume, let's take it up 23.7. So we've gone from 24 to 23.7 and 16% marginal propensity to invest down to 15.8. Now let's see where we end up. So we've just done a small change. I'm just flowing with this. I'm just seeing where it's going. Change it, go through the rounds. All right. So by just raising the taxes and making small changes to the marginal propensity to invest and the marginal propensity to consume for capital, we're getting very close to the original 16.1 trillion effective demand limit. So in a sense, if you raise taxes and transfer that money to labor, raise taxes on capital, transfer that money to labor, yes, nothing else changes. The real GDP natural equilibrium level will rise. But there will be some offsetting consequences. Capital will consume less and they'll be less likely to invest. And these changes can offset that rise in taxes and bring you back to the original effective demand limit. Now this is cause for future research to really understand if that effective demand limit is the attractor point for these dynamics. Let me repeat this. If you raise the taxes, yes, you'll raise the equilibrium natural level of real GDP, but will the offsetting changes bring you back to the effective demand limit determined by labor share, which has its effect on capacity utilization and the employment of labor. This is going to be the real key to future research to find out if that effective demand limit, which seems stable as the economy is increasing real GDP through the business cycle, is the effective demand limit the attractor state for adjustments within the economy. So if you raise the taxes on capital, that these modifications to these other variables align themselves with the effective demand limit. This seems to be there's something holding the effective demand limit constant through the business cycle. And then there are certain changes that happen towards the end. But there's something that's holding it constant. And if it is itself an attractor state, this is something to research. Okay, so just wanted to say that yes, raising taxes on capital will increase the natural limit of real GDP, but there will be some changes in other factors on how capital income uses its money that can bring you back to the original effective demand limit.